While the RBI released final guidelines for project loans extended by lenders today, the final norms are significantly easier than the draft guidelines that have been released in May. My colleague Vishwanath Nair joining me on the phone line with more. Vishwanath, if you can actually take us through the guidelines that were released in May and what has actually changed right now. We understand that it is now getting easier for banks and, of course, for these bigger infrastructure projects.
Right, Tamara, so May of 2024, last year, was when the draft guidelines were first issued, and these draft guidelines were specifically geared towards increasing the scrutiny on bank and non-bank loans towards infrastructure projects. So since then, of course, there's been a lot of back and forth. The industry has repeatedly said that the rules that have been proposed in the draft set were too onerous, because they had required a 5% standard asset provisioning against any loan. What does that mean? Essentially, for every 100 rupees that a bank gives out to a project, 5 rupees needs to be set aside as standard asset provisioning. And now, in the final guidelines, what has changed is that the RBI has reduced that number to 1%. Only in the case of commercial real estate projects, that number is at 1.25%, but still, overall, it's a significant sort of reduction from what the RBI had required banks to do back in May of 2024. The other important aspect of this entire set of guidelines is that the RBI has also eased the way in which banks can issue or extend the date of commercial commencement of operations. So a project has a specific date on which it starts commercial operations, so which can be extended by up to 3 years if it's an infra project, if it's an infra project, and by 2 years if it's a non-infra project. In both these cases, banks have significant flexibility, not just banks but also non-bank lenders have significant flexibility to extend the date of commercial commencement of operations depending on what they see as a commercial need within these parameters of 3 years and 2 years. These guidelines coming in now are a bit of a surprise. Actually, most people were expecting the final guidelines to come at some point only in March. But the guidelines have come out now, and the implementation date is now being set for 1st October. So banks have a significant period of time before they have to actually get these guidelines online and ensure that their loans are covered under whatever prescriptions the RBI is giving. The one thing that is clear is that the RBI original draft was significantly more prescriptive on the process, but in this specific case, in the final guidelines, that seems to have gone, and banks and non-banks have significantly more flexibility in drafting their own policies.
Absolutely, Vishwanath, sounding like important for banks is they don't have to lock up as much money as before, so they can lend easily to these bigger projects, and for developers, because that does mean easier access to loans, means it's simpler to get funding for infrastructure and real estate projects. I'm going to bring in Samuel Joseph Jebaraj, Deputy Managing Director, NABFID. Thank you so much, sir, for joining us, and good evening to you. Welcome to NDTV Profit. First up, how are you seeing the RBI's reduced provisioning requirements for under construction and operational project loans impacting the flow of credit to infrastructure projects, especially from institutions like yours?
Well, this is a very welcome development from RBI. In fact, as just now Vishwanath was saying, this has come as a surprise. In fact, we were not expecting it to come so early. But a lot of clarity has come. A lot of ambiguity and complications have been removed from the draft guidelines. It has been made much easier. For instance, in the earlier draft guidelines, RBI talked about provisioning based on the NPV differential and all that. That would have made it very, very complex. Now they have made it very, very simple, easy to implement, and harmonized it across all regulated entities. So this is one part of it. But there are a lot of other positive things for project finance itself. They have brought in a lot of clarity as to what is project finance, when do we disburse, how much land should be available upfront, what are the approvals that are absolutely required before we do. So a lot of clarity has been brought in, and I think this will strengthen project finance going forward.
Mr. Samuel, hi, Vishwanath here. I just wanted to ask you, at some level, this must feel like a bit of vindication for the lender community, because you've been asking for these, specifically this 1% number, I remember, was one of the recommendations that was made by the lender community.
Yeah, RBI has been very gracious, I should say, to roll it back from 5% to 1%. And after that, if there is a DCCO delay, for every quarter they have added 0.375 percentage, which means for every 1 year, we will have to make additional 1.5%, which is fair enough. Which projects go through a stress in implementation period, I think it's only fair that we make additional provisions. And also for reversal of provision, also they have made it much simpler and easier. Earlier, for reversal to begin, 20% of the debt had to be repaid. Only then we can reverse. But now they have said after COD, after commercial operations date, if interest and principal repayment has started, then we can bring it back to 0.4%. So that's a very welcome move from RBI.
Samuel Joseph, sir, thank you so much for joining us this evening, and thank you so much to my colleague Vishwanath for bringing us that perspective. We'll continue tracking the story and bring you all of the developments.
Thank you. Thank you.
Thank you.